Let's dive into one of the biggest questions in personal finance. You get a big chunk of cash. What's the right move? Do you jump right into the market all at once, or do you carefully dip your toes in over time? It's a classic showdown, really, pitting cold, hard math against our own, very human psychology.
All right, let's make this real. Just picture it. You get an inheritance, a big bonus from work, you sell a house, whatever it is, you've now got $100,000 sitting in your bank account. I mean, your heart's probably beating a little faster just thinking about it. The question is, do you put all of that money into the market, like right now, today? Or do you play it safe and spread that investment out over the next few months? This isn't just some textbook problem. It's a real, high-stakes choice a lot of us will face.
And this is where it gets interesting. Because on one shoulder, you've got decades of financial data whispering what the optimal move is, but on the other shoulder, you've got your gut. You know, that little voice screaming, "Don't mess this up." We're going to break down this entire battle, but you're definitely going to want to stick around because the real answer isn't just A or B. We've got a powerful third option we'll reveal at the end that might just be the perfect fit for you.
Okay, so let's start with the case for speed, for taking that lump sum and investing it all at once. The official term is lump sum investing, or LSI for short. And you know, when you just look at the raw historical data, the numbers are, frankly, pretty one-sided.
This single number really says it all. There was a huge landmark study done by Vanguard, and they looked at mountains of market history. What they found was that investing a lump sum all at once beat a more gradual approach about 68% of the time. Think about that. Over any given year, the odds are literally 2-to-1 in favor of just getting your money in the market as fast as you can.
So, why? Why does speed usually win? Well, it boils down to three really simple, powerful truths about the market. First, there's what we call positive market drift. Basically, over the long run, markets tend to go up. It's their natural direction. Second, there's opportunity cost. Every single day your money is sitting in cash, it's not just missing out on that upward drift, it's actually losing value to inflation. And third, and this is the big one, it's the power of compounding. When you invest it all at once, your entire sum starts earning returns from day one. More money working for you for more time.
Okay, so if the math is so clear-cut, why is this even a debate, right? Well, it's because we're not spreadsheets. We're people. So now let's flip to the other side of the argument. This is the case for caution, for what's called dollar cost averaging, or DCA. And here's the key. This strategy isn't really about optimizing your math. It's about managing your mind.
The biggest reason to go slow isn't mathematical. It's emotional. It's a direct antidote to something called regret risk. I mean, just imagine it. You finally pull the trigger, you invest that whole $100,000, and the very next day, the market tanks. That gut punch feeling, that intense, "what have I done?" That is regret risk. Dollar cost averaging is designed specifically to protect you from that feeling by breaking one giant, terrifying decision into a bunch of smaller, less scary ones. And there's actual science behind this. It comes from Nobel Prize-winning research on a powerful cognitive bias we all have called loss aversion. And it proves something we all kind of feel in our bones. The pain of losing money is felt roughly twice as strongly as the pleasure of gaining the same amount. It's not logical, but it's fundamentally human, and it explains why our brains just scream at us to play it safe and avoid these big, one-shot risks. Let me put it this way. You find $1,000 on the street. Feels pretty good, right? Now imagine you lose $1,000 from your wallet. That feeling is way more intense. It feels at least twice as bad. And that emotional imbalance is exactly why the single all-in bet of lump sum investing feels so daunting. We're often willing to give up some potential upside just to get that smoother ride that DCA provides, to protect ourselves from that crushing feeling of one massive, bad decision.
Okay, so theory's great, but how do these strategies actually hold up in a real-world trial by fire? Let's put LSI and DCA head-to-head in three of the worst, most brutal market crashes in recent memory. This is the ultimate stress test.
What's fascinating here is that the shape of the crash really determined the winner. Take the dot-com bust in 2000. That was a long, slow, grinding downturn. In that world, dollar cost averaging was the absolute hero. You kept buying shares at lower and lower prices, and it led to a massive gain. But then look at 2008. That was a completely different beast. A sharp, terrifying crash followed by a powerful V-shaped rebound. In that case, DCA protected you from the worst of the fall, but the lump sum investor who had more money in at the absolute bottom actually came out ahead in the long run. And then in the 2022 bear market, we saw it again. DCA provided incredible downside protection. So the takeaway is clear. Not all crashes are created equal.
So, we've got the math on one side, psychology on the other. We know that different types of markets favor different strategies. How in the world do you figure out what's actually right for you? It's time to stop talking theory and build your personal playbook.
Choosing your path really comes down to answering 3 honest questions. First, where did this money come from? If it's just from your regular paycheck, hey, you're already dollar cost averaging every 2 weeks. This whole debate is really for those one-time windfalls. Second, you have to know yourself. What keeps you up at night? The fear of regret after a crash, or the fear of missing out on a huge rally? Be honest. And third, what's your time horizon? If you're investing for 30 years from now, a dip next year is just a blip. If you need the money in 3 years, it's a much bigger deal. So far, we've kind of framed this as a simple binary choice, right? All in or bit by bit. But the smartest answer is often not at the extremes. So, just as we promised, let's look at that third way forward, the one that can give you the best of both worlds.
Okay, so check out these 2 powerful alternatives. First is a simple hybrid strategy. You're basically splitting the difference. You invest a big chunk now, maybe 50%, so you get that immediate market exposure. Then you dollar cost average the rest. It's a great compromise. Or, for those who want to be a bit more strategic, there's enhanced DCA. Here, you still have a plan to invest over time, but you intentionally invest more money after the market takes a dip. You're basically turning a passive strategy into an active one and systematically buying when things are on sale.
So let's tie this all together with some clear recommendations. The right move really depends on your investor personality. If you're a rational maximizer, you've got nerves of steel and a long time horizon, then yeah, the data says invest it all now. If you're an anxious investor and you know a big drop will make you panic and sell, a simple DCA plan is a small price to pay for peace of mind. For most of us who are probably pragmatic realists, a hybrid or enhanced DCA strategy is probably the sweet spot. And hey, if you're a long-term saver just investing from your paycheck, you're already on the right track. Just keep doing what you're doing.
And in the end, this is really what it all boils down to. You can stare at charts, you can argue about math versus psychology all day long, but none of it means anything if you don't have a plan you can actually follow. The biggest mistake isn't choosing the wrong strategy. It's letting fear or confusion paralyze you into doing nothing at all. So, the best strategy isn't the one that looks perfect on paper. It's the one that lets you sleep at night. It's the one you can stick with through good times and bad.